In 1999, a company that sold pet supplies online went public and was instantly worth more than Delta Airlines. It had never made a profit. It would be bankrupt within 9 months. And yet, on the day of its IPO, investors treated it like the future of commerce itself. This wasn't an isolated mistake. It was systematic delusion at scale. Between 1995 and 2000, the stock market didn't just rise, it detached from reality. Companies with no revenue were valued in the billions. Business plans written on napkins attracted venture capital. And the phrase, "getting eyeballs," replaced the need for actual profit. The dot-com bubble wasn't just a financial event, it was a collective psychological break that destroyed $5 trillion in market value and reshaped how we think about technology, investing, and hype. But here's the thing, some of the ideas were right, the timing was just catastrophically wrong. The internet became publicly accessible in the early 1990s, and almost immediately, a certain kind of person started saying the same thing. Everything is about to change. They weren't wrong, but they were early. And in markets, early often looks identical to wrong. By 1995, Netscape went public. Its stock doubled on the first day of trading, even though the company was losing money. That moment broke something. Investors started believing that old rules didn't apply anymore. Profit didn't matter. Cash flow didn't matter. What mattered was growth, momentum, being first. Venture capitalists began funding anything with a .com in the name. The logic was simple. The internet is the future, so internet companies must be valuable. Notice the leap. The internet being transformative didn't mean every internet company would succeed. But that distinction got lost. By 1998, you could raise millions of dollars with a PowerPoint and a domain name. Experience was optional. A business model was negotiable. What you needed was a story. Here's how the feedback loop worked. A startup raises money. It spends that money on advertising to acquire users. More users means higher valuation. Higher valuation means more funding. More funding means more advertising. At no point in this cycle does the company need to make money. It just needs to grow. Pets.com spent over $11 million in advertising in its first year. Its revenue was less than $6 million. Webvan, an online grocery delivery service, raised $375 million and built a nationwide infrastructure before figuring out if anyone actually wanted the service at scale. They didn't. eToys was valued at $8 billion at its peak. Toys R Us, a real company with real stores and real profit, was worth $6 billion. The absurdity wasn't hidden, it was celebrated. Magazines ran covers declaring the new economy. Analysts said stock valuations didn't need earnings anymore. They needed vision. Alan Greenspan, chairman of the Federal Reserve, called it irrational exuberance in 1996. The market ignored him and tripled anyway. Because when everyone around you is getting rich, skepticism feels like cowardice. Let's talk about what was actually happening beneath the hype. Traditional valuation uses something called the price-to-earnings ratio. It compares a company's stock price to its actual profit. A normal P/E ratio might be 15 or 20. That means you're paying $15 for every $1 of annual profit. During the dot-com bubble, many companies had infinite P/E ratios because you can't divide by zero. No earnings meant no ratio. But investors didn't care. They used a new metric, price to sales. Forget profit. How much revenue is the company generating? But even that became irrelevant. By the late 90s, companies were being valued on projections, not current sales, not current users, future hypothetical dominance of a market that didn't exist yet. This is where it gets uncomfortable. These weren't scams. Most founders genuinely believed. Most investors genuinely thought they were early to the next industrial revolution. But belief doesn't change math, and the math was simple. If a company burns more money than it makes, it will eventually run out. The bubble didn't pop all at once. It deflated in stages. In March 2000, the Nasdaq peaked at just over 5,000. Then it started falling, slowly at first, then faster. By October 2002, it had lost 78% of its value. $5 trillion evaporated. Pets.com went bankrupt in November 2000. Its mascot, a sock puppet, became the symbol of the entire collapse. Webvan shut down in 2001, destroying $800 million in investor capital. eToys filed for bankruptcy. Boo.com, a fashion retailer that spent $135 million in 6 months, collapsed. Hundreds of companies followed. But here's the important thing. The crash didn't happen because the internet failed. It happened because the companies were built on a foundation of negative unit economics. They were losing money on every transaction and trying to make it up in volume. That doesn't work. It never works. The survivors were the ones who had real businesses underneath the hype. Amazon lost 90% of its stock value during the crash, but it survived because it had revenue, infrastructure, and a long-term model. Google went public in 2004 after the crash. It had profit from day one. The bubble didn't kill the internet. It killed the fantasy that you could ignore fundamentals forever. So what did we learn? For about 5 years, the answer seemed to be, don't trust tech stocks. The trauma was real. Investors who lost everything swore off internet companies entirely. But then something interesting happened. The ideas from the dot-com era started working. Online shopping became normal. Streaming replaced physical media. Cloud computing made software scalable in ways that weren't possible in 1999. Pets.com failed. Chewy, launched in 2011, succeeded. Same idea, better timing, actual logistics. Webvan failed. Instacart, launched in 2012, succeeded. Same idea, smartphone adoption, gig economy infrastructure. The dot-com bubble wasn't wrong about the future. It was wrong about the present. The technology needed to mature. Consumer behavior needed to shift. Infrastructure needed to exist. By 2010, all of that had happened. And the companies that launched after the crash had one massive advantage. They remembered what didn't work. They knew profit mattered. They knew burn rate was real. They knew hype was not a business model. The recovery wasn't a return to the bubble. It was a maturation. Here's the uncomfortable part. This pattern repeats. Every transformative technology goes through a hype cycle. Railways in the 1840s, radio in the 1920s, biotech in the 1980s. The technology is real. The potential is real. But the timing is always misjudged. Early investors confuse a real trend with a guarantee of individual success. Capital floods in. Valuations disconnect from reality. Then physics reasserts itself. The crash feels like the end, but it's actually the beginning. Because after the hype dies, the real work starts. The survivors build sustainable businesses, the infrastructure matures, and 10 years later, the impossible ideas from the bubble become ordinary parts of life. The dot-com bubble destroyed trillions in wealth, but it also funded the infrastructure for the internet we use today. So the question isn't whether the next bubble will happen, it's whether we'll recognize it while we're inside it. Because the thing about bubbles is this: they always feel different when you're living through them. Until they don't.